When gold crosses $4,000 an ounce, the world doesn't cheer, it holds its breath. Because every time in recorded financial history that gold doubles from its previous high, something breaks. Not a small correction, not a routine recession, something structural snaps. The kind of snap you only understand years later, when you look back and say, that was the moment everything began to fall apart. And right now, that moment is happening again. As I'm speaking these words, gold has surged past 4,379, a number that should terrify investors far more than any bad jobs report, any inflation headline, any Federal Reserve press conference. Because gold isn't climbing out of optimism, gold isn't climbing because prosperity is around the corner. Then gold climbs for one reason. Pressure inside the system has reached a point that can no longer be contained. Most people have been sold a bedtime story. When stocks fall, gold rises. When gold rises, you're safe. A simple, comforting inverse relationship. But that fairy tale has cost ordinary Americans more money than any bad investment they've ever made. Because the truth, the real truth, is far darker. Gold doesn't rise because it's safe. Gold rises because everything else is breaking. And when gold doubles, it isn't celebrating. It's screaming. This isn't fear-mongering. This isn't conspiracy. This is the mathematical autopsy of every major collapse in modern finance. Look at early 2024. Gold hovered around $2,000 an ounce, the kind of stable price financial advisors love to use when lecturing clients about 5% diversification. The markets were euphoric. Tech was booming. Retail investors were bragging on social media about AI stocks tripling. The S&P was brushing against all-time highs. Politicians were telling the public the economy was resilient, and yet, beneath that surface, something ancient, something older than the dollar, older than the stock market, older than the United States, was beginning to tremble. By October 2025, gold passed 4,379s. That jump wasn't just a price move, it was a verdict. A verdict on currencies, a verdict on debt, a verdict on governments, a verdict on the entire global financial architecture. Every time gold erupts like this, the same unbreakable sequence unfolds. Gold sits still for years, the world grows complacent, debt swells, currencies weaken, central banks panic, something snaps, gold doubles, markets fall 40–80%. It's happened in 1971, it's happened in 2000, it's happened in 2008. It's happened in every modern crisis we've lived through. And now it's happening again, except this time the scale is global, synchronized, and dangerously compressed. Gold usually doubles after the crash begins. This time it's doubling before the crash. That alone should chill every viewer watching this. Because when gold moves first, it means the smart money, the banks, sovereign funds, and central banks, is already running for the exits, and everyone else is being left behind in a burning building, without realizing the flames are already crawling up the walls. So, here is the question that should haunt every saver, every retiree, every investor. If gold doubling always signals destruction, what does it mean that it has doubled before the collapse even starts? What is gold warning us about, not years from now, but right now? What breaks next? The stock market, the dollar, the banking system, or the entire monetary order we thought was unshakable? Because gold doesn't rise when things are good. Gold rises when time is running out. And the doubling isn't a milestone, it's a countdown. Most people believe gold rises because investors suddenly discover it during a crisis. As if gold is just a backup plan, a fire extinguisher you buy when you smell smoke. But that idea is wrong, completely backward. Gold doesn't react to crises. Gold anticipates them. It moves months, sometimes years, before the public realizes anything is wrong. That is the paradox Wall Street never explains, because the moment you understand it, every comforting narrative about diversification collapses. The truth that nobody tells you is simple. Gold doesn't go up because it is safe. Gold goes up because the system has already begun to unravel beneath the surface. By the time gold doubles, the crash isn't coming. It's already here, hidden, delayed, disguised. But the public doesn't see the cracks because modern crises don't start with flashing red headlines or bank lines stretching around the block. They start quietly. A currency wobbling in a foreign market, a central bank printing a little too aggressively, a government rolling over old debt with new debt, a liquidity pocket drying up in a corner of the bond market. These aren't visible to the average person, but gold sees them before anyone else. Think back to 2000. Everyone remembers the dot-com bubble bursting, the Nasdaq collapsing 75%, and fortunes evaporating overnight. But what did gold do? It began rising before the first tech stock imploded. While CNBC was celebrating the new economy, gold was already whispering, "The math doesn't add up." The same paradox played out in 2008. The public saw the crisis in September when Lehman Brothers collapsed. But gold started screaming months before that, climbing from $650 toward $1,000 while banks were still stamping subprime mortgages with AAA. The doubling didn't cause the crash. The crash caused the doubling. Gold moves first because gold isn't reacting to headlines. It's reacting to structural fractures inside the financial machinery. Here's what makes the paradox brutal. Even though gold signals the crash, gold itself crashes during the crash. Most investors don't understand this, so they panic. In 2008, gold fell from over $1,000 to under $700 in months. It was a violent drop that convinced millions that gold failed as a safe haven. But the reality was far more sinister. When liquidity disappears, everything falls, even gold. People weren't selling gold because they didn't trust it. They were selling gold because they needed cash to survive. And then, once the forced selling ends, the real movement begins. After the 2008 liquidity shock, gold surged for 3 straight years, from 765 to 1,373 ton. Not because the economy recovered, but because governments printed trillions to keep the system alive. And every dollar printed to save the system weakened faith in the system. This pattern repeats in every era. Liquidity panic, gold falls. Money printing, gold explodes. Currency confidence dies, gold doubles, markets collapse 40–80%. It's not random, it's not emotional, it's not investor sentiment, it's mathematical. And here, in 2025, the paradox is even more terrifying. Gold has doubled before the liquidity event, before the panic selling, before the crash that forces governments into money printing overdrive. That has never happened in modern financial history. If gold always doubled after the system broke, what does it mean when gold doubles before? It means something inside the system has already snapped, quietly, invisibly, behind closed doors, and the effects simply haven't reached the surface yet. Gold isn't predicting chaos. Gold is revealing chaos that's already begun. And that brings us to the part of history most investors ignore. The part that shows this pattern didn't start in 2000 or 2008. It stretches back almost a century into the darkest financial collapse America has ever seen. To understand what gold is warning us about today, we have to go back to the beginning. To a moment when the US monetary system failed so completely that the government had to rewrite the rules of money itself. To understand why gold doubling is a doomsday signal, we need to go back to the last time the US financial system shattered so violently that the government had to reinvent money. The year was 1929. The stock market was soaring. Credit was expanding like a balloon pulled too tight. And Americans believed they were living in a new golden age of prosperity. Radios, cars, skyscrapers. Everything felt unstoppable. The newspapers said the market would rise forever. The Federal Reserve said the system was sound. But beneath that glittering surface, debt was metastasizing like a silent cancer. Margin loans were exploding. Banks were gambling with deposits. Speculation had replaced investment, and the entire economy rested on a fragile tower of promises that could only stand as long as confidence held. Then, in October 1929, confidence vanished. The Dow crashed 89%. Fortunes vanished in days, banks failed by the thousands, and breadlines curled around entire city blocks. But here's the part history classes rarely mention. While everything collapsed, gold didn't just hold steady. Gold mining companies soared. The most famous, Homestake Mining, went up tenfold during the darkest years of the Great Depression. Why? Because even though gold was officially fixed at $20.67 an ounce, the relative value of gold skyrocketed as everything else around it fell apart. Paper assets collapsed, currencies weakened, debt imploded. But gold, the one thing no government could print, became the only anchor remaining. The U.S. government panicked. In 1933, President Franklin D. Roosevelt signed Executive Order 6102, making it illegal for Americans to own most gold. People were forced to surrender it to the government, not because gold was dangerous, but because gold was too powerful. Gold was the one asset that exposed the true weakness of the monetary system, and once the government seized that gold, they revalued it from $20 to $35 per ounce, a 69% jump overnight. In other words, the government devalued the dollar and used gold to cover the hole. That was the first modern example of the gold doubling pattern. And it happened not because gold changed, but because the monetary system underneath it collapsed. Fast forward to the 1970s. After decades of overspending on wars and social programs, the US no longer had the gold reserves to back all the dollars it had created. So in 1971, President Nixon severed the last link between the dollar and gold, a moment now known as the Nixon shock. Freed from its anchor, gold erupted, from 35 to 875, a 2,400% surge. And just like every other doubling cycle, the eruption happened during a historic breakdown. Inflation hit double digits. Unemployment soared. Oil prices quadrupled. Stocks stagnated for a decade. Living standards fell across the country. Gold doubled and redoubled because the dollar was dying in slow motion. Then came the 2000s. The dot-com crash wiped out trillions. Gold doubled. Then the housing bubble burst. Gold doubled again. Each time the pattern remained identical. Debt grows, currency weakens, system cracks, gold erupts, markets collapse. And now we stand at the edge of the most dangerous repetition of that pattern yet. Because this time, the pressure points aren't isolated to one country or one sector. Japan is drowning in debt. Europe is battling inflation and recession simultaneously. China is facing a real estate implosion. The US is carrying more debt than any nation in human history. The last time the world saw this much pressure building at once was 1929. And gold is reacting exactly the same way, except faster, louder, and earlier. Gold is not rising because everything is stable. Gold is rising because everything is cracking. And if history teaches us anything, it's that once gold doubles, the pattern does not reverse, it accelerates. Now that we've rebuilt the past, it has time to connect the dots, to see the mechanism that links every crisis across 100 years into one repeating, unavoidable cycle. Because the pattern didn't end with the Great Depression. It didn't end with 1971. It didn't end with 2008. It's still running. And right now it's reaching its most dangerous phase. When you line up the crashes of 1929, 1971, 2000, 2008, and now 2025, a chilling pattern emerges. Not a loose coincidence, not a vague similarity, a repeatable mechanism, almost mechanical in its precision. Every crisis follows the same 7-step rhythm. Step 1. Debt expands beyond what the system can support. Governments overspend. Corporations overborrow. Consumers overleverage. The entire economy becomes a castle built on IOUs. Step 2. Currencies weaken under the burden of those promises, not visibly at first, but beneath the surface, purchasing power slips away inch by inch. Step 3. Central banks intervene, gently at first, then aggressively. They lower rates, they expand balance sheets, they stimulate the economy with money nobody earned. Step 4. Something cracks, not in gold, but everywhere else. A sector collapses, a bubble bursts, a liquidity pocket evaporates, a bank wobbles. Step 5. Smart money runs for the exits. Sovereign wealth funds, central banks, and institutional giants quietly rotate out of paper assets and into hard assets, especially gold. Step 6. Gold doubles, not slowly, not politely, violently, suddenly. Like a pressure meter blowing past the red zone. Step 7. Markets collapse 40-80% every single time. Not because gold caused it, but because gold was the only asset honest enough to reflect the truth while everything else hid behind accounting tricks and political optimism. The pattern is so consistent that historians can track it like a heartbeat. Look at it in rhythm. 1929, gold stable, dollar collapses. Government revalues gold, 1971, gold untethered. Currency breaks, inflation explodes, 2000, gold doubles, Nasdaq collapses, 75%, 2008, gold doubles, financial system implodes, 2025, gold doubles before the collapse. That last one changes everything, because in previous eras the pattern looked like this: crisis, panic, government prints, gold doubles. But today, the pattern is reversed. Gold doubles before the crisis is visible. It's as if someone cut into the timeline and moved the final warning to the beginning. Why? Because the system has never been stretched this thin. Not in 1929, not in the 1970s, not in 2000. Not even during the near-death moment of 2008. Consider the pieces. Global debt is at its highest level in human history, over $315 trillion. The US alone owes $37 trillion, with interest payments now larger than the defense budget. Japan's debt to GDP is over 250%. Europe is juggling inflation, energy crises, and recession. China's real estate market, the largest asset class on Earth, is imploding. Every major economy is under strain at the same time. Layer by layer, the pattern becomes unavoidable. Add too much debt, then too much money printing, add weakening currencies, then geopolitical tension, add banking fragility, add inflation that erodes trust in money. Then watch what happens. Gold doesn't rise, gold erupts, gold doesn't whisper, gold roars, gold doesn't protect you, gold warns you. And here is the part that should send a chill through every investor. In all previous cycles, gold doubled during the crisis. In this cycle, gold has doubled before the crisis. That means one thing: the pattern has already begun. We just haven't felt the impact yet. Gold is pricing in events we haven't seen, but institutions already have. Behind closed doors, in central bank meetings, sovereign fund strategies, and shadow banking liquidity reports, the warnings are already flashing. The public won't know until the breaking point arrives. And the next step in the pattern, after gold doubles, is always the same. The present collapses into the past. History reawakens. And the same forces that toppled old empires return to finish what they started. Which brings us to the most unsettling question of all. If gold is already screaming, what exactly is happening right now, in 2025, that the public hasn't seen yet? The most unsettling part of the gold doubling pattern isn't what happened in 1929, 1971, 2000, or 2008. It's what's happening right now. Because for the first time in modern history, the warning signal is flashing before the crash, and the data behind it is more alarming than anything we've seen in a century. Let's step into 2025, not through headlines, but through the numbers the public never reads. The numbers gold reacts to, long before anyone else. 1. Debt has outgrown reality. In 1929, US debt was high. In 1971, it was concerning. In 2008, it was dangerous. But today the world is running on $315 trillion of debt, the highest level in human history. The United States owes $37 trillion and is adding over $1 trillion every 100 days. Interest payments have surpassed military spending, a red flag every empire sees right before decline. Japan's debt to GDP is over 250%, an economic cardiac arrest. Europe is juggling inflation, recession, and energy instability. China is battling the slow-motion collapse of a property market larger than the entire US stock market. Every major pillar of global finance is shaking. There is no safe region. The pressure is global, synchronized, and irreversible. 2. Central banks are panicking. Quietly. In 2008, central banks cut rates. In 2020, they printed $10 trillion, but in 2025, they've run out of tools. Rates in Europe and Japan are already near zero. The US can't raise rates without detonating its own debt bomb. Emerging markets can't defend their currencies without burning reserves. China is injecting liquidity to stop its shadow banking system from collapsing. With no remaining levers to pull, central banks are doing the one thing they only do when they're terrified. They're buying gold, in secret and in record quantities. In the first 3 quarters of 2025, central banks purchased 634 tons of gold. The People's Bank of China bought 220 tons in a single quarter. Kazakhstan accumulated more gold than many developed nations hold in total reserves. These are not diversification moves. These are preparations. Governments can print dollars, euros, yen, but they cannot print gold. When the institutions that create money start hoarding the one thing they cannot fabricate, it means they no longer trust the system they built. 3. The dollar's foundation is cracking. For 80 years, the US dollar dominated global trade. It was the world's reserve currency, the backbone of the global monetary order. But the tide is turning. BRICS nations are trading more in yuan, rupees, and local currencies. Saudi Arabia is accepting non-dollar payments for oil. Central banks are reducing dollar reserves. Gold reserves are rising as fiat credibility falls. American debt is becoming unmanageable, not in theory, but in math. Every empire falls the same way. Their currency loses trust before their government loses power. And for the first time in history, the world is openly building a system that does not depend on the dollar. Gold is not rising because of inflation. Gold is not rising because of recession. Gold is rising because the dollar's monopoly is fracturing. 4. Geopolitics has turned into a currency war. And wars cost money. Money governments do not have. The conflict in Eastern Europe is draining NATO budgets. The South China Sea is a powder keg with $1 trillion fuse. Middle Eastern instability is pushing energy prices higher. US-China tensions are driving economic decoupling. In past eras, governments responded by raising taxes. But today, with fragile economies and angry populations, raising taxes is political suicide. So they use the only tool left. They print, and every printed dollar makes gold stronger, and the dollar weaker. 5. The unprecedented signal. Here's the part that breaks the pattern in the most terrifying way. Gold has doubled before any visible crash. Stock markets are still near highs. Unemployment is low. Corporate earnings look stable. Consumer spending hasn't fully collapsed. On the surface, everything looks normal, but gold isn't reacting to the surface. Gold is reacting to what S underneath. The structural fractures the public wanted to see until the shockwave hits. And history shows that when gold moves before the crisis arrives suddenly and violently. The markets don't slide, they fall off a cliff. Which leads to what matters most, not the system, not the banks, not the governments, but you. Because when a global reset hits, the impact isn't theoretical. It hits savings, it hits paychecks, it hits retirement. It hits every ordinary American who trusted a system that was already burning from the inside. When we talk about gold doubling, when we talk about markets collapsing 40–80%, when we talk about currency systems breaking, most people shrug and think, that's Wall Street's problem. That's Washington's problem. That's something rich people worry about. But the truth is brutally simple. When the monetary system cracks, the people who feel it first and hardest are ordinary Americans. Not hedge fund managers, not politicians, not central bankers. It is the school teacher who spent 30 years contributing to a pension that suddenly loses half its value. It's the truck driver whose grocery bill doubles while his paycheck stays the same. It is the family of 4 watching their mortgage become a weight around their neck as interest rates rise and wages fall. It is the retiree who saved diligently for decades, only to learn the dollars in their account buy 40% less than they used to. This isn't theory. It's not speculation. It's what happens every single time gold doubles. Let's break down the consequences. Not for the system, but for your life. 1. Your savings lose value. Faster than you can earn it. Back when gold erupts, the message is clear. Currencies are dying, and when the currency dies, savings die with it. The erosion doesn't happen slowly. It happens in sudden jerks. Groceries jump 15% in a month, rent spikes 20% in a year, insurance premiums rise 30–40%. The cost of medical care explodes. Utilities devour more of every paycheck. Your dollar doesn't collapse all at once, It collapses in bursts. And by the time the public realizes what's happening, years of savings have already vanished in purchasing power. 2. Retirement plans get hit harder than any other asset. In every gold doubling cycle, 1929, pensions vaporized 1970s, retirement savings lost 50% of real value 2000. 401ks became 201ks. 2008, Americans lost $2.4 trillion in retirement funds. People think diversification will save them. But diversification doesn't help when everything falls together. Stocks fall, bonds fall, real estate freezes, even cash becomes a liability because inflation eats it alive. And when the dust settles, most retirement accounts never recover their original purchasing power. 3. Jobs disappear. Fast market crashes don't just hit asset prices, they hit livelihoods. After every major gold doubling event, 1930s unemployment hit 25%, 1970s stagflation wiped out entire industries. 2000's crash unleashed a flood of layoffs. 2008 eliminated 8.8 million jobs. In 2025, the situation is worse. Why? Because today's economy is built on record high corporate debt, fragile global supply chains, declining productivity, rising operational costs, automation, replacing workers' razor-thin profit margins. When the crash hits, companies won't trim, they'll slash. 4. Housing markets don't crash, they freeze. Many Americans assume a crash will make homes cheaper, but history shows something far more painful. Housing becomes unaffordable even as prices fall. How? Because during a crisis, banks tighten lending mortgage rates, spike credit, evaporates, fewer people qualify for loans, sellers, panic buyers disappear. You end up with the worst of both worlds, high mortgage costs and falling home values. This is exactly what happened in the 1970s, in 2008, and what is beginning right now as gold surges. 5. The middle class gets squeezed into extinction. When currencies weaken, the wealthy shift into hard assets. Gold, land, commodities, international real estate, private equity, rare stores of value. But ordinary workers, they stay trapped in cash, the asset that dies first. Every gold doubling cycle leaves the same scar. The middle class shrinks. Wealth concentrates. Inequality explodes. This is how empires decline, not through invasion, not through collapse, through the slow suffocation of the middle class. 6. The emotional impact is worse than the financial one. No historian ever writes about this part, but it's the most important. When the monetary system cracks, people lose their sense of stability. They lose confidence, they lose security. They lose trust in the future. Parents fear they can't provide. Young people feel locked out of opportunity. Older Americans feel betrayed by a system they supported all their lives. This emotional wound is deeper than any market loss. And it is exactly what gold doubling is signaling today. A moment where the world's financial architecture is shifting under our feet. But if you understand the truth, if you can see the pattern, if you know what comes next, then you can avoid the fate that history has delivered to millions. Because the final step of every gold doubling cycle isn't chaos, it's clarity. And that is where we go in the final chapter. There is a moment in every financial crisis when confusion finally gives way to clarity. When all the noise fades. When the charts, headlines, forecasts, and political narratives collapse into one undeniable truth. And the truth is this. Gold doesn't rise because it's valuable. Gold rises because everything else is becoming worthless. It's the simplest, darkest, most reliable signal in the history of money. For over a century, the world has watched the same pattern unfold. The system grows bloated with debt. Governments dilute currencies to delay the reckoning. Inflation erodes public trust. Cracks form in banks, markets, and sovereign balance sheets. Gold erupts, markets collapse, then the system resets. This cycle has played out through the Great Depression, the end of the gold standard in 1971, the dot-com crash, the housing bubble, and the near collapse of 2008. But 2025 is different, not because the pattern changed, but because the pattern has accelerated. For the first time, gold doubled before the collapse began. That means the system is already breaking under the surface. We just haven't witnessed the public shockwave yet. And gold, the oldest signal humanity has, is telling us that the world we know is shifting into a new chapter. Let's bring all of this together. The entire cycle. In one sentence. If you understand nothing else from this documentary, understand this. Gold is not predicting collapse. Gold is pricing in collapse that has already started. When gold quietly doubles, it is the market's way of whispering, the currency is sick. When gold doubles loudly and violently, it screams, the currency is dying. And when gold doubles while markets are still euphoric, like today, it warns, the system is already broken, the crash will be sudden. This is not a forecast, not a prediction, not a dramatic exaggeration. This is history. Cold, brutal, repeating history. The awakening. Every empire believes its currency will last forever. Every generation believes this time is different. Every society trusts the system, right until the moment the system no longer works. What gold doubling tells us is that the global economy is entering a phase the world hasn't seen since the 1930s. Debt beyond repayment. Currencies losing credibility. Governments trapped between default and inflation. Central banks hoarding gold. Geopolitical conflict pushing nations toward economic war. The middle class suffocating. Markets priced for perfection. And a financial architecture cracking from within. The institutions with the best information on earth, central banks, sovereign funds, and global lenders, have already moved. They are not waiting for announcements. They are not waiting for headlines. They are not waiting for confirmation. Their actions are the confirmation. The doubling has happened, the countdown has begun, and the people who survive resets, who come out stronger, not weaker, are the ones who learn to see through the illusion of safety. The illusion of stability, the illusion of everything is fine. Because the truth buried beneath a century of financial history is that money systems don't collapse slowly, they collapse suddenly, after years of pretending everything is fine. Gold doubling is the signal that the pretending is over. The human choice. So the final question isn't, what will the government do? What will Wall Street do? What will the Fed do? The real question, the only question, is, what will you do now that you can see the truth? Will you move early, like the institutions that already acted? Or will you wait until the headlines scream what gold has been whispering for 2 years? Will you trust the system? Or will you trust the only asset in history that has survived every system? Because in the end, the survivors are not the ones who trusted paper promises. The survivors are the ones who recognized the pattern. If this documentary opened your eyes, if it gave you clarity, if it broke the illusion, then stay here. Because the next video will show the part they never teach in school. How resets actually happen. Who wins, who loses, and how ordinary people can protect themselves when the monetary order shifts. History doesn't repeat, but if you ignore its warning signs, it will crush you all the same. Subscribe. Not for me, but for your future. Because the countdown didn't start today. It started when gold doubled, and time is already running out.